Good morning, good afternoon, and good evening. It's Friday, March 24th, 5:29 p.m. Welcome to episode 72. This is Mark Yu.
Wawi Santos present on 7-2.
Sure, it's not QE.
I'm not sure. It's
So,
starting to feel like it's going to be.
yeah. So, welcome to the Mark Yu and Huawei Show, episode 72. So, this is a good way of tracking down the markets on a weekly basis. Me and Huawei are not registered financial analysts or planners. Don't consider what we talk about here as investment advice. We just like to share and share our thoughts about the markets and how we move our money, along with the big wigs of Wall Street. So on a weekly basis, we take a look at the American Association of Individual Investors. So let's see how the sentiment over the market is doing right now. This was published a couple of days ago. As of March 22nd, there is a slight uptick in bullish for people who think the market will be going up. 20.9%. Still a little low compared to its historical average of 38%, and about as low as it could be in the past month. Bearish investors are nearly half at 48.9%, and neutral investors, one third or 30%. So not a lot of bullishness or positive sentiments in the stock market over the past week, but we'll see the performance of the S&P 500 in a second. So for the S&P 500 for the past week, it's actually up another 1.37%, believe it or not, for the past week, despite the fear of banking insolvency, which was precipitated by the Signature Bank and then Silicon Valley Bank just about 3 weeks ago. Would you have expected this, Huawei, as a result of the bank crisis that's ongoing?
Well, yeah, I'm expecting a faster recovery just because of newer technology and faster liquidity with retail investors driving the market. So a lot of this is new investors pushing the market quickly into recovery. And unlike 2008, 2009,
Hmm.
this is not as bad as people think. It's more of a contagion fear, in my opinion, what's going on.
Yeah. People are still definitely pulling out money by droves from banks, as we're going to see in a little bit, according to the latest Fed data or Federal Reserve data. But for the volatility on the S&P 500, it's actually down 16% in the past 5 days. So not much up and down swings, I guess, for volatility measurements, but definitely not like it if you're tracking the market every day of this week. It's been a rocky ride at least.
Mhm.
The NASDAQ, it's up 1.8% again for the past 5 days. So it's the second week in a row. So that's quite impressive for the tech sector. Meanwhile, volatility in the NASDAQ, it's down 11%. So yeah, according to Financial Times, US stocks notch back-to-back weekly gains despite banking turmoil. So that's impressive. Like as of this morning, we just saw a news report coming out from Europe that Deutsche Bank is crashing, like it's down quite big. Down, oh, it's back down to 3%. Wow. This morning it was down as much as 13%, if I'm not mistaken. But looks like fear has eased on this bank. So those who are not aware, it's the biggest bank in Germany. So it's quite interesting now that Credit Suisse has been taken over by its fellow UBS. And now looks like the market is trying to go on a ramping contagion spree, going cross
Mhm.
borders and going to Germany, but looks like it's backstopped by Germany's prime minister saying that the bank is sound. So we just have to stay tuned if there's going to be any bank run over the weekend, if it's possible. I know for sure in the Philippines it would be hard to cause a bank run because I have an account with BDO, and
Mm-hmm.
they usually, especially in paydays, every 15th and 30th day of the month. I don't know if it's intentional or their servers for their websites just keeps crashing during paydays. So they won't be able to serve a lot of customers during a bank run. So yeah, I don't like their service at all. I rank their service a very low end in my personal experience.
Well, that's a good point, Mark. So, you know, fast liquidity, fast liquidity, with technology may pose some risk at the cost of convenience.
Mm,
And but I think more importantly, looking at these banks that have failed, they have a lot of bank deals that are not common to most banks. So I think in the few more days we'll see more of these deals that had transpired over the years that caused some of these banks to collapse or liquidate.
right,
Uh, Aside from that, I think people just finally realize, a lot of their customers have realized that they have a lot of money held up that is not going to be covered by insurance, and they decided, oh, I better pull this out and put it in other banks instead of just one bank.
right,
That's
for sure.
another, because the FDIC will only insure about 250,000.
Hmm.
So they probably realize, oh, I have too much holding in this one bank. I better move it somewhere.
True. Like you don't want to be overexposed, especially if you have more than 250,000 in savings or liquid, especially for businesses.
Exactly.
So the fear and greed index, currently we're at level of 33 compared to 25 last week, a little bit higher, but still in the greed territory. The market momentum, we have bounced back up since March 15th. So this is another trend here that's forming. We're on the positive side of things compared to 125-day moving average, which is a little bit of a good sign. If you're a market believer and you think that the market will eventually, return to its uptrend. And if you're going to look at the put and call options, looks like we're close to 1, which
Mhm.
means people are still thinking that the market might go down in the short term. So for the groups for the past week, oh wow, look at that, Bobby. Communication services and technology again for the second week in a
Mhm.
row, as definitely a reflection of what NASDAQ has done or has achieved for the
Mhm.
past couple of weeks. And
I
as the
think
yeah,
I think it's trying to rotate into into like easy money again.
right. And we're gonna see that in a little bit as we have some charts from the Federal Reserve itself. Whereas last week we noticed that spike $300 billion in financial assets by the Federal Reserve after having begun tapering it off since last year. So the best performing sectors, services and technology, consumer defensive, healthcare, energy is up surprisingly for the past week, whereas real estate and utilities are the worst performing. I've been seeing articles Huawei saying that the commercial real estate is the next canary in the coal mine that's going to be exploding and causing a lot of banks to fail because of a lot of office spaces not being rented. Therefore, landlords are having a hard time refinancing and being able to afford at the much higher interest rates on these banks. So that's one thing to watch out for. One thing that we have mentioned, one company that we have mentioned in the group that's suffering from a lot of sell-off recently is I think it's the Vornado Realty.
Realty. Mhm.
So we're going to take a look at the stock price. It's actually up nearly 5% today, but it's down
Mhm.
4% since the start of the week. So I don't think people are panicking right now, actually. But yeah, since the start of the year, we're now, oh my gosh, wow, we're now down to the first quarter already. Wow, we believe it or not, for
Yeah, Mark, I think
2023.
I think things are going quickly.
Mhm.
Second quarter is here before you know it.
Already second quarter, and next thing you know, we're diving into the earnings reports of
Hmm.
big companies. So start of the year, technology is the best performer, followed by communication services and consumer cyclical. The rest are in the red. The worst performing sector, believe it or not, is energy. It's almost down 10%. Whereas last year, since the start of the war, it was the best performing. Even before the start of the war, I think energy has already been the best performing sector last
Hmm.
year, all year long. And now how things have changed. Technology is number one, energy is down south. Wow, how things could change in a year, right? Well, we
Yeah, as far as stock price performance, you could see that um, it's positioning towards more. I think people are just following the wave, and that's what's happening here. They're just following the, sector changes. But I wouldn't uh, bet against energy. In fact, I'm increasing my holdings on midstream because of the current changes that are going on. Um, we still need to fuel the economy, and we don't have the infrastructure for your so-called renewables and renew EV powered vehicles to you know to disregard oil and gas. So this is a vital sector in the economy that we should keep an eye on, and I think still worth investing in at this time.
I agree. I think despite the lawmakers, passing laws left and right about people can no longer buy oil powered cars in some states. In the end, it'll take a lot of years before that, before electric vehicle can actually replace oil powered cars. That's
Yeah,
my
I have the same opinion because of the current situation. They cannot, meet the demand, and the cost for having an EV is still so high for for your standard customers.
right. I agree. So next on the slide is the fund flows. So we're just gonna take a look where the money is going, and let's see if it's worth it to follow where they're going in. So according to Reuters, this was just published about 8 hours ago. Global money market funds weekly inflows hit 3-year high. A lot of people are pulling their money, it looks like, from stocks and some of the bond funds, and they're parking it in money market. So massive inflows to money market amid turmoil in US and European banking sectors. So let's see. Oh wow. If you're looking at YouTube or you're watching our video on YouTube, you'll definitely be able to see the ones that we're discussing. There's a chart here provided by Refinitiv Lipper Data, which is owned by Reuters from March 1st, and then March 15th and March 22nd. During those 7-day periods, billions of dollars are flowing into the money market fund. Looking for safety, looks like.
Yeah,
Meanwhile,
that's refuge, money market. Even certificates of deposit have gone up. These short-term certificates of deposit have gone up to 5%.
wow. So that's good. I mean, people are getting paid now because of their hard-earned money, not because of taking a lot of risk.
Mhm.
So meanwhile, global equity funds received their first weekly inflow in 6 weeks. A net of 13.37 billion came into the global stocks. Investors purchased US and Asian stock or equity funds. US worth 10.19 billion, Asian
Wow.
3.6 billion, while Europe had experienced outflows of $2.15 billion. So looks like people are slowly rotating a little bit, piling into some US and Asian goods, stocks. By sector, consumer staples and tech saw $500 million close each of net buying, while investors pulled 405 million from metals and mining. Interesting.
That is interesting.
So I guess they're piling into the winners so far this year. And if we're gonna look minings, I'm not sure where they're at. Basic materials close to flat since the start of the year. So bond fund flows are still rising. Not bad. I guess people are getting a little bit bullish despite the banking situation in both US and across the Atlantic, Europe. So this is a chart here that's a little bit troublesome. Good thing Bloomberg provided this chart. It said discount window borrowing reaches all-time high. It even surpassed the 2008 crisis.
Oh, wow.
So that's that line right there. That's not a part of the graph. I mean, that's not part of the label. That's actually a spike, indicating a lot of borrowing made by the banks in
Yeah.
in such a short period of time. So the discount window, according to Bloomberg, it's the means of last resort, actually. So this borrowing increases during periods of stress. So it enables the central bank or the Federal Reserve to lend banks money for up to 90 days, where the banks would put up collateral, like government bonds, in order to be able to borrow. So it's a good article here at Bloomberg. It kind of explains the rest. But what's the most important thing is it means that a lot of banks, since the collapse of the Silicon Valley Bank back in March 10th, are a lot of banks are asking for more money, or at least loaning a lot of money to make their finances solid and make sure that they have enough funds to operate.
Yeah, so that's part of the swaps that they are doing to inject more liquidity into the global, banking system. Aside, and some of them will just put in collateral as their own country's currency against the dollar to get more dollars into their banking system. So this is a plus for the United States, being the value holder of currencies globally, since some other countries are positioning to take over some of this value. But for stability, everyone else is looking for US dollars.
Could be indirectly, yes, because this is for US banks for sure, the discount window. So now we're gonna take a look at the money market. It's at all-time high, as what we have just pointed out, $5.2 trillion. So a lot of, maybe this is the next bubble. What do you think?
Well, it's a good bubble because that money market fund will go into some form of investment or, project, in
Yeah.
my opinion. So I think that's a good thing for that to burst.
Well, according to Bank of America, it's identifying it as the next bubble and says investors should sell stocks rather than buy them after the last rate hike. So I'm not quite sure what he means. Money market funds exceeded $5.1 trillion, 300 billion more over the past month. Biggest weekly flows to cash since March 2020. So the last two times money market fund assets surge was back in 2008 and 2020. And we both know what happened there. The Federal Reserve slashed interest rates. And so it said here, Hartnett is fond of saying markets stop panicking when central banks start panicking. So the surge in Fed discount window, which we just talked about, has historically occurred around the big stock market low. There is one difference this time, in that inflation is a reality and that labor markets remains exceptionally strong. So I guess what he's trying to point out here is, quote unquote, credit and stock markets are too greedy for rate cuts, not fearful enough of recession. After all, when banks borrow from the Fed in an emergency, they tighten lending standards, which in turn results in less lending, and that leads to less business optimism, which eventually cracks the labor market. So I'm not so sure. I guess just to be safe, you want to be a little bit more on the safe side, in my opinion, and you don't want to be going all in the market right now, just because we still have the inflation to fight and there's still a strong labor market despite banks collapsing left and right. Well, at least it has maintained its solvency in the past 7 days. So the deposits. So this is another article from Bloomberg, which is quite interesting. So financials have been taking quite a good amount of hits in the first quarter of this year. They're the third worst performing sector, believe it or not, down 5.6%. And so far, according to this article that was just published a couple of hours ago, US bank deposits declined by most in history, or in nearly a year. Deposits declined more than 98 billion in week, ended March 15. The decline is entirely due to a slump at smaller banks. So actually, according to this chart, we've been experiencing withdrawals from commercial banks since October of last year. And now it's been pulling out a little bit more each day, each week, until the recent bank collapse. So we're now down to $17.5 trillion of bank deposits. So I don't know what to do about this data. It looks like it's a little troubling, from 18.1 trillion down to 17.5, but that's still a lot of money. What's interesting is it has never happened, looks like, in the recent history. Wow. Past 10 years.
Yeah, we didn't do easy money in that volume until COVID started. So
Maybe
that's what sparked it.
maybe that kind of explains why people are panicking, pulling out their banks. And you know what? I think the main reason why we just, light bulb just happened. Could be because money market, like what we just mentioned, has been paying out a lot better interest compared to banks. Banks are paying cheap, and they don't value their depositors that very much. So people are moving their money to better income generating sources like money market. So now we're taking a look at the Federal Reserve assets. Last week, the spike about $300 billion. So now let's take a look a week later. And boom. We're now at 8.7 trillion. Oh my. So from 8.6 trillion, we last week, we're now at, we have added $733 billion in the past 2 weeks. So some say that the Fed, this is not a quantitative easing that's happening. They just erased how many months? from November to March. 5 months worth of quantitative tightening, a lot of rate hikes and nonstop. They haven't been buying since they started cutting rates last year in just a matter of 2 weeks. 5 months of tightening, 2 weeks of easing. That has just happened.
Mm-hmm.
And that's
It's an emergency backstop for the banks, so they
right.
had to do it.
And what's interesting, it coincides with the S&P 500 and the NASDAQ's performance in the past 2 weeks. They've been up
Mm-hmm.
a nearly, well, more than 1% each week.
Mm-hmm.
So market's liking it. Market quantitative easing, or believe it or not, I guess, whatever you call it. If it's not QE, I don't know what they call it. The Chicago Fed National Financial Conditions. If this goes lower, negative, it means that it's belt tightening period. If it goes higher, I think it goes easier. Let's see. Positive values. Oh, sorry. Positive values are tighter, negative values are looser. So despite the QE that's happening, financial conditions in money markets and debt and equity markets have become more strict or tightened. I don't know. This is sort of conflicting to me because obviously the S&P 500 is up. Money markets, there are a lot of people piling into the money markets. A lot of people are in the debt markets.
Mm-hmm.
Oh, I know why it's showing tightening. Maybe it's because of the shadow banking. It's hard to determine.
Well, number one, there's still a lot of supply of money, but we don't have enough products to buy. So that's part of the supply demand issue right there. The Fed will be forced to pause, in my opinion, coming, next rate hike cycle. So
Mm.
just to ease this liquidity issue that's happening in the not just in the domestic market but in the global market, they have to ease on the rate hike, and most likely they'll pause, to allow some of that money to move.
Right. I think right now they just said that they're gonna raise one more time, one more 25 basis points.
Mm-hmm.
And according to the forecast of CME Group, 80% is on that camp.
So we'll see how that changes. It just depends on the stability of the financial market. They will have to move some way or the other. Looks like they're good about stabilizing it right now, but we don't know how things will shake up in a few more weeks.
Mm. So, yep. Despite that, the survey of consumers provided by University of Michigan, consumer sentiment dipped down a little bit, negative 5% in March compared to February, but still it's going up. And that kind of reflects of what just happened in the housing market.
Mm-hmm.
This is in February. Home sales spiked nearly 15% despite the tightening. So this is despite the mortgage rate up around close to 7% in March. So despite the higher interest rates, people who would be buying houses are still buying, that's for sure.
Mm-hmm.
And let's see. Well, this morning, me and Wally were talking about in the group, our messenger group, that Deutsche Bank has been having some issues. And right now, just after the market close, or well, I guess this was published this morning, Janet Yellen calls for Friday FSOC meeting after banking sector turmoil. So I don't know, maybe there's another bank that's close to blowing up, or are they just trying to make sure that everybody stays safe or stays solvent over the weekend? What do you think, Wowie?
Well, they're pressured right now. Number one,
Mhm,
people are hesitating to take any loans, and that's where banks get most of their business is on their consumer loan side. Who's doing a lot better right now are the exchanges,
mhm,
and brokerages. They're still doing okay, but banks are very sensitive to the housing market and auto loans and stuff like that. And with not a lot of customers,
mhm.
getting new cars, or you know and with the used car sales dropping, um, they're not getting a lot of business right now.
Right, and I think because of the collapse as well of the recent banks, I'm pretty sure a lot of banks right now are tightening their belts and not just approving loans left and right. So take
Hmm.
care of the credit score for sure.
And they're forced to invest in high risk, um, like bonds, and who knows what else they're investing in. But we already know what the failed banks have done that caused their failures. It just over leverage,
Mm,
overstretch, and into some deals that are kind of shaky.
right.
But that's the type of market we're in right now. It's shaky
Mhm.
because of the high interest rates and the low uh, consumer loans, that's happening right now.
Right. Well, we'll see if the Federal Reserve will turn off the faucet again, because we're seeing a good amount of QE being printed, $700 billion in 2 weeks, erasing a lot of tightening that had happened for past 5 months.
Hmm. Their aggressive tightening has definitely taken effect,
Mm,
but the effect has happened so fast in the financial sector that it's really scary for a lot of people.
right. And inflation is still up there. So that's one difficult terrain to
It's
win.
entrenched. It's entrenched until we start trading again with our suppliers.
Right. Well, I guess that does it for this week's episode 72. Before we end, Wabi, do you have any quote to share?
No, just hang tight, and just think that is long-term investing is the key. You know, long-term investing is the key. This too shall pass. I think that's what I want to say to our investors. My brother likes to say this saying, this too shall pass. And for our short lives, it is really true.
Mhm. All right. Well, thank you again, Wawi, for joining us. I appreciate your time. And for those listeners who are tuning in, thank you guys. Please hit the like and subscribe. Again, this is Mark Yu signing out.
And this is Wawi Santos. Thank you, Mark. Thank you, listeners. Click and subscribe.